Now, many developments that COVID-19 has accelerated, including in the tech sector, especially the fintech sector. Very, very exciting time. I just want you to walk me through, Murray, on what Bluecode is, where it started, and what the reason for that was.
Sure, and thanks for the interest. Bluecode is a digital mobile payment, mobile phone to mobile phone. But it's an actual merchant acquiring payment. So it's like a debit card without a debit card. There's no cards involved whatsoever. So it's really to facilitate a mobile payment between any customer from any bank to any merchant from any other bank, and then all of the settlement that happens in behind it. And it aims to, eventually start to edge cash out of the market and provide more digital transparency.
All right. Now, I see that this started because European companies, basically, they saw that it wouldn't be a good thing if geopolitical tensions arose because they were using card payments from the US. And we are living in a quite shaky environment right now where geopolitical tensions have become quite prevalent. And I just want to know, how has Bluecode made these agreements politics proof?
Yeah, well, I mean, Bluecode does come out of Europe, where it has a substantial impact. And the reason why Bluecode started was because Europe, when Eurocard was sold to MasterCard, Europe became completely dependent on two American corporations for all of their payments, which, in an ideal world wouldn't matter. But in the world that we live in now, as the pendulum swings away from globalization into more national and regional focus, those kind of dependencies are quite dangerous, particularly in Africa. So in Africa, if you're going to increase the efficiency of the economy with digital transformation and digital payments and nudge cash out for a more efficient interaction, you can't do it if you're going to be doing it with a card that's dependent, or a card scheme, even without the plastic, a virtual card, if you're dependent upon an offshore scheme, whether it's from China or America. So what Bluecode does is Bluecode has brought the technology to Africa, operates within the nation state with a partner, licenses locally, operates in local currency. There's no foreign exchange commissions on any transactions, in a very efficient revenue share. But if there was ever any kind of geopolitical kind of interference or an embargo, our license agreements released to our local partners. So the business continues, payments continue, and is sanction proof. And I think that's very important. If you're going to bring a global technology into a local market without creating dependencies.
Now, Murray, tell me about Bluecode's reach in Africa. What are the certain countries that you are concentrating on, and what are some of the risks and the challenges that you have encountered in Africa?
Explaining it has been a challenge. Getting the idea across of what it is and what the important elements are, because there's really three kind of major stakeholders: the public sector in terms of the regulator, which we're just talking about, commercial banks and non-bank financial institutions who have an interest in their shareholders, and then consumers and consumer behavior. So there's a whole lot of chaotic business, chaotic fintech going on in the marketplace. Most of it's a lot of Me Too technology, siloed payments, or trying to replicate the M-Pesa phenomenon. So breaking through the noise has been a bit of a challenge. We had originally thought we would focus on a couple of small countries and demonstrate this, but instead we got drawn straight into the center of some of the largest economies. So we're in Nigeria. We have gone through a lengthy POC with the payment gateway. We've signed up 2 banks. We have a local business partner, and we're going into production in Nigeria now. And we've got some advanced discussions again in Ghana and in South Africa as well. South Africa is a particularly interesting case. So those are the major sub-Saharan economies that we're focused on right now. But we aim for a SADC play and a West African play broadly. So those are the markets. The challenges haven't been that hard because in terms of, once the idea is explained and what Bluecode does, people get it, bankers get it, regulators get it. And understand the value proposition. So it's now a matter of going through the process of rolling out and building up local partnerships and capacity.
Now, talking about your reach in Africa and what you are currently encountering in the continent, are there any lessons to be learned from the international experience?
There are. The offshore dependencies, dependencies on external corporations, data protection. Bluecode is completely operates without customer information. If you can't allow, like a card carries your customer information on a chip and it's transferred to a POS terminal and it's in circulation, so compliance. So if you can obviate the need for that with an anonymous virtual payment, token payment, it goes a long way to resolving a lot of issues for payments. So lessons learned, yes. Instant payment settlement is a big push across Africa. Reducing the time of settlement between banks increases competition between financial institutions, allows non-traditional players in. Standards, going around with a standard QR code for all operators to use and allow for competition between the various players in the banks. And interoperability is essential. We can't succeed if every bank and every fintech thinks they have a winner-take-all strategy. They have to be able to exchange, should be able to pay from any source of funding to any other funding account. You should be able to pay from a loyalty program from a tier 1 retailer, a bank account, a credit cooperative account, whatever, to any merchant in any way that they want to receive the money.
What are some of the main issues that regulators and legislators are concerned about when it comes to payments?
Well, it's really the regulatory environment that are driving those transformational changes that I was just talking about. Regulators have to, first of all, they have to protect the national payment system. A bank doesn't necessarily care if there's a dependency on a card scheme offshore in the US or a platform like Alipay from China, because it's profitable for them in the short run and they're making money. But it's not in the interest of the country to replace cash with external dependencies. So regulators have to pay attention to those kind of dependencies if we're going to really promote digital transformation. Secondly, regulators have to make sure that we have a very efficient payment system, increasing the velocity of payments, reducing friction, protecting the market, security, data privacy, and ultimately creating an enabling environment for a more competitive, cooperative and interoperable market, and democratizing the process. So I think those are the major themes that all the regulators are focused on right now, and we're seeing the results already.
Now we go to traditional banks and we talk about how they do need to be changing things. Things have been accelerated, of course, because of COVID-19, and banks need to be forward thinking. So what do banks need to be thinking about, in terms of mobile payments?
Well, again, I think banks need to find an off-ramp from legacy. A legacy system is like a card scheme or any, the old way of doing things, and you can't just put a fresh skin on it. You can't take away the plastic and put the same thing on a phone, but still be dependent on legacy transactions, legacy infrastructure. So we need to find an off-ramp from legacy that isn't going to cannibalize the bank's revenue, provide them an equivalent revenue, but at a much lower cost point by disintermediating a lot of costs. So there's an opportunity. The banks have to cooperate. The banks have to look for alternate settlement to be able to interoperate and still differentiate between themselves with a digital payment on the account rails and get off the cards and not try to keep deepening legacy. So I think that's important. And to unencumber themselves from siloed payment solutions.
We do know that the informal sector needs more access to finance. And I mean, what are the real opportunities here for banks, especially looking at how they still need to differentiate themselves while also cooperating with the changing environment and changing human behavior?
Sure. And like whether it's tier 1 retailers or established commercial banks, they are only going to be able to grow by in a zero sum by taking customers from each other, or they have to grow the pie. And here they are operating in the formal sector, and you've got in South Africa, maybe 20% of the economy operating in the informal sector. In other countries, the informal sector is as much as 65% of GDP. It's opaque, you can't see it. And the only way a bank can see it is through data. So a bank needs to provide a merchant payment to small business, those that are underserved at the bottom of the formal economy and those that can be served that are close to the edge of the formal economy, give them a digital payment from the bank, let them have payment acceptance, let the payments come to the bank can see the payments, collateralize the cash flow, and offer other products, insurance, savings, accounting services, et cetera, to grow those businesses, stimulate the economy, create jobs, create wealth, and then just keep driving out further. And until we light up, the majority of that informal economy by learning how to get the transaction costs down and use data effectively. That's the process we've been through for 2 decades with the consumer. We need to pivot to the productive economy. And I think it's absolutely essential.
And just moving to retailers, I mean, Murray, retailers have been using card payment systems forever. Some may be even feeling hostage to it. I'm just interested in how retailers are responding to the challenge of digital mobile payments.
Well, the irony is banks would be nowhere without retailers, and retailers would be nowhere without banks, but it's not a democratic conversation at all. The retailers have got all the acceptance, all the places where people can pay with those cards. But the banks own the cards and they own the customer that wants to pay. So the banks get to dictate how much they're going to charge a merchant in order to have the privilege of that person paying with a card. And it's huge. It's a huge fee. And it's built on legacy and a whole stack of inefficiencies. And they're just passed on to the merchant. So the merchant then, in a super competitive environment, has to take it out of margin, and they all do, but it's essentially passed on to the consumer. And then new fintech comes in and says, well, we've got a new payment, but we're connected to the cards. It'll cost you 3% or 5%. We'd like to use it. Just pass it on to the consumer. So that's not right. I think that the merchants should have some participation in a more democratic engagement in the payment system. And if we have an account rail-based payment where a consumer and also the retailer, their principal concern is loyalty of the customer. They've got to keep that customer engaged with them because they're in an intensely competitive environment. So they give the customer loyalty, they give the customer an app. That app has to have more utility. With Bluecode, you can put Bluecode in that app, a piece of software that points to a bank, so the customer can use their loyalty app to draw money from their bank to pay a merchant, and the retailer can participate. Everyone has to increase the size of their addressable market. And what's that? That's the excluded. We have to do more with the people we've got, and we have to be able to do something with the people we don't.
Very real opportunities there. Thank you very much for that insight. That was Murray Gardiner, the MD of Bluecode Africa.